Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome to the Greedy Trader channel. Well, I'm not exactly greedy, as most of you old watchers of the channel will testify. I have the most conservative approach to trading. It's just a nice parody idea from the Gordon Gekko mantra. There are only two kinds of traders, the greedy ones and the fearful ones.
Greed, for lack of a better word, is good. Greed is right. Greed works.
Those of you who are new to the channel, this is where you can learn how to really trade like a professional. Every video I make is packed with real examples with before and after scenarios, so you can see that it is simply a question of sticking with the plan and not changing it because you're having an emotional meltdown. In this video, I'm going to talk to you about why you should stop paying up and down on your trades. If you're wondering what that means, then you definitely need to stick around. Trading is difficult because your broker, algos, and other participants are constantly eroding any edge you may have. This is why we need to be very efficient on how we get in and out of trades. I have not seen any guru talking about this. All I see is them making winning trades. If you want to know how to keep your edge intact and avoid paying up on every single trade and wonder why your P&L is so shoddy, then this is the video for you. Let's dive in. All right, so hi guys. Like I said, we are going to discuss the concept of paying up and paying down. Now, I know a lot of you guys are maybe very new to trading who are watching this. Some of you are quite experienced and probably are looking back at your P&L and saying, well, I've been trading for a long period of time and I really haven't seen maybe much progress, or my P&L looks a little bit awkward. Maybe I'm winning trades, but I can't understand why my losing trades are exceeding my winning trades. And effectively, there's probably just a lot of questions. And that's understandable, because that's the point of this video, is that there's something that a lot of people don't talk about, especially people who are experienced with trading. And that's a real shame, just because when you have a lot of experience as a trader, or you are mentoring people, or you have a huge maybe institutional background where you know more than others, I think it's really important that you share that, because even if you as a trader are thinking that that wasn't your real edge, then share that with someone, because they might find that that was their edge. That was the thing that they were missing. And it's really funny, anyone who's traded in an environment where there are other traders, for example, would probably agree with me and say, well, how many times have you looked across a room and realized that actually there are so many other traders doing things that are hugely beneficial to the way you see the market? I can definitely credit some of the things that I now know and understand, and my ability to trade as well as I do, why most of you are with me, following me, watching these videos. It's in fact the core of why I'm doing this, is because I just think that as hard as trading is, we can all make it easier for ourselves. Anyway, I'm not going to get all kumbaya about this, but the bottom line is that we all need to pretty much listen to one another. And I think we all need to start really thinking about what we're doing if we want this to be a long-term pursuit for ourselves as traders. Okay, so back to the concept of paying up and paying down. What does that mean? Right, so for those of you guys who are familiar with maybe depth of market level 2 dome perhaps, and have traded on a dome, maybe you're an equity trader, maybe you traded small caps, or maybe you traded futures, so you are well aware of the concept of a depth of market or dome and what bids and offers are. So this is not something that is going to be new to you. However, if you're a new trader, you probably have no clue. You have no idea what I'm talking about, and that's okay, because in this video I'm going to break a lot of that down. So if you, for example, had a dome and you were trading a dome and you've got 10 price deep on the bids and 10 price deep on the offers. Now, what you're always going to trade like is if the market is going up, then it's offering up, right? As a buyer, you're going to set a limit order, which means that you're going to set a limit order at the bids. So you're going to put a buy limit at the bids. So let's say you're bullish. So effectively what then happens is the market offers up for a little bit and then it comes down and then hits your bid, right? And then you're long now on the asset. But instinctually, what happens in a trade like that is that when your bids hit, it just essentially means that you're buying a more efficient price because you're not paying up to the offer. What you're doing is you're waiting for the price to come to you and allowing your bid to get hit. That's how most professional traders trade. Whilst obviously when you're trading on a CFD platform, everyone gets into the habit of hitting market. And when you hit market, essentially you're paying up, right? So you're going to the offer. So if you did that, for example, on an exchange, right? So you were trading a futures exchange and you paid up, you're probably going to get a really bad feel, for one, because not only are you now paying up at the offer, you're not really getting an efficient price. You're hitting market, and sometimes if there's a lot of volatility, you can be filled 2 or 3 price lines up, right? And that's all paying up. It's bad habits.
Well, if your goal is a long life, that chili cheeseburger is a step in the wrong direction.
Now, for the experienced trader, they will be sitting with their limit orders at the bid. So they'll be looking at things, for example, like absorption. They'll be looking to see how many passive orders are sitting there. So what are the passive orders on the book? And is it likely that sellers are going to get absorbed if sellers go to the bid, for example? And those are the kind of things they're trying to observe and they're trying to understand. So professional traders largely get into the habit of executing on the bid as opposed to paying up on the offer. And it's exactly the same in reverse. If you're trying to get short, you'd probably want to get short on the offer. So if the market is going down, right, you want to wait for it to go back a little bit up, right? So you can then now execute your short, effectively sell at the offer. And whoever you're selling to at the offer in order to get into that short position is going to end up being long at the offer, right? So they're going to have to pay up in order to, get filled themselves. So your opponent or the person on the other side of your trade is technically in the worst position because they've had to pay up. In your case, you didn't have to pay up. You sold exactly on the offer. And in a way, that's the same way take profit works. So most of you have seen a couple of my videos and I've talked about my trifecta method, which is, for those of you who don't know, liquidity, volume, and time. Now, the reason I built this trifecta method is because I understood this. I fully understood the idea that if you are going down on a market, as I like to say, you don't want to be short in the hole. You'd like to see us go back to a relevant area of demand and supply. Well, in the case of a dome, you'll be able to see that as well. So you're looking for an area where you're going to get decent liquidity, essentially where there was prior interest, demand, and supply. So it's really simple when you break it up into those terms, right? So let's take a look at what we're seeing now today. And I'm just going to zoom in very, very big here so we can see. And to illustrate this example very, very clearly. Now, I'm going to use today currently because there's a lot going on here today because it's Fed week. So we're getting the Fed on Wednesday, which is tomorrow. So there's a lot of crazy volatility, a time that we shouldn't really be trading. In any case, what are we seeing? So we've got a little demand area here for those of you who've been following my videos. And if you haven't, just check out my videos on my trifecta method, how I do it and how I effectively trade and how I build this heat mapping, which essentially gives me my demand and supply picture. And then obviously for those of you who watch my videos, you can tell it's highly accurate and it's not magic. It's just me putting in the work and the time to kind of understand the demand and supply picture, which is part of my second trifecta. But, I'm not going to get into my trifecta methods today. Today, we're primarily going to talk about paying up and paying down. So in this example, if we look at what happened in the demand area, okay, so we put in some demand in at the London Open, right? So my time trifecta, which is major center opens, right? So we put in some demand in the London Open. Now, what you would notice is very quickly is that once we close the price, the market bid a little lower. So again, going back to that example, if the lowest price is 25.24, which means someone was long at 25.24, and if somewhere midway it was 25.29, and then effectively the high is 25.37, then our best execution comes at the lower thirds, right? So the lower third of this bar. And that means that we're going to look to get long at those kind of prices, right? So that means that we're not paying up. Now, most people, at least that's what I've seen, I've worked with a lot of people when it comes to trading, I've also had a lot of institutional experience. I've had market making experience. So I'm able to see what traders tend to do a lot more. So what you would see a lot of the time is that traders will wait for the reaction. So we get a close on the bar here and they will get long at 25.32. That will be their initial play. Some traders will wait for the trade to break higher into 25.38 and then get long on the offer. And they're doing this by hitting market. Now, professionals would say, well, it's fine. We're going up and that's great. I'm not going to get any FOMO. I'm not going to miss out on this trade. I'm going to wait for the market to come back. So they will then start to set prices. So when we pushed up, they'll start to look at the demand area again as where they want to stack their limits, 25.28. They might want to scale in. By scaling, I mean, they might go, I'll buy a standard lot at 25.32, for example. I'll buy another standard lot if we go to the low of that bar at 25.28. And I'll buy another standard lot if we can get really deep, 25.26. So they've taken a scaling approach, and maybe they might say, well, my stops are going to be below the London range, which is 25.23, or it's going to be below the prior day demand in London as well, which was 25.12, right? And that becomes their risk reward profiling. But because they've scaled in, they've achieved an average, right? So as opposed to it just being one trade in, they've achieved an average. And that's because they trust as professionals that the price is going to go back and retest an area of high liquidity, which is my first trifecta, right? Which will be the demand zone, right? Now, again, think about the P&L position of trade. So the trader that has decided that they are going to be long at 25.41, which will be paying up on the offer, and the trader who has waited for the price to come to them and is long, say for example at 25.30. Now think about each person's P&L position right now. So the trader who was long at 25.30 is making a profit of 25, let's say 25.43, is making a profit of 13 ticks. Now the trader who is long at 25.41 is making a profit of 4 ticks, right? Because they paid up. Now, equally, for a trader who is trying to get short, who will be on the opposite side of this vehicle, let's say they got short in the hole at 25.28. Well, they're now down quite considerably. Very shortly, they're going to be down about 20 ticks. And they have been down about 20 ticks dynamically. In fact, they were down 30 ticks. So those traders are likely to liquidate their positions. They're not going to be able to stay in. So it's also disadvantageous for you, even if you're on the opposite trade, because you lose more money. You need wider stops, and that affects your risk reward ratio or profiling, because now it's wider when it didn't need to be. Now, I have no problem with a trader getting in at 25.28, for example, and then maybe having wider risk, right? Because the price is still efficient. However, I have a problem with the trader paying up at 25.41 and taking wider risk across the range to maybe a significant low. Because we also do know that at these kind of lows, we can experience liquidity hunts, right? So the market could come down, take out the stops and go higher. So this is all the reason why we want efficient pricing, so we can extend that risk a little bit more to protect ourselves from potentially liquidity being taken away from you, right? So again, as a professional trader, you think a lot more about these things, and that's going to help your trade position. So again, ask yourself, if you are losing on a trade, then it's because you're more than likely paying up. Now, if we do another example from yesterday was a really awkward, choppy day, right? And for most people, this was quite a tough day to trade. But again, if you look at this from an example standpoint, so we've got the London Open, which was at about 8 a.m. There was some demand down here, and you can clearly see if you were trying to get short here, that wouldn't have been a good trade. That's obvious. Even though we were trying to flush out the traders in London, this became a liquidity hunt as opposed to a genuine move to the downside. And that's why I always say don't get short in the hole, because now in a trade like this, you are paying down. So even if you were going to get short, you would at least want us to go back to the upper third, close enough to the supply, or get short at the supply. Now think about this. A trader who got short at the supply, even though the market went higher, was still able to get short at about 25.39 or close to, and was still able to exit in the demand zone at 25.16. That was a profitable trade. So if you were just trading from supply to demand, that would have been a profitable trade. Again, a trader who got long on the demand, and say for example we dipped lower and we had bids at the lower third, depending on where you placed your stops, you could have pretty much still hung on to this trade. So even if you did lose out, you would have lost out a lot more money, still found a supply opportunity to get short, and you'd have still found a demand opportunity here if you were following my demand and supply, so my second trifecta volume. So it just really depends on where you get in, and I think that's the lesson you should be taking from this, is that if your execution is good, even trades that were going to turn out to be a loss, or looks like they were going to be a loss, may well end up incredibly profitable just because of your execution. Now, by the same token, let's say that you were that trader who decided to pay up on the offer. So we saw the demand on London, it closed up here, 25.30, and you decided to get long. Well, you got stopped out at the bottom of the bar because that would have been really wide risk. It was 25.30 to 25.13. Right, judging by the range of cable, that's really big risk nowadays. Again, if you were that trader who tried to get short in the hole, you would have had wide risk to above the supply, in which case you were taken out in the Chicago Open. Right, so think about this, guys. Really think about this. Like, this, tweaking this alone could potentially change everything about your trading. Just tweaking that idea alone. Now, really think about this, guys, because I keep repeating this consistently, even in my Discord server. And by the way, I will leave a link in the description below if you want to kind of know a little bit more about how I do things. It's completely free Discord, so check it out. I'll leave a link below. But even in my Discord server, I'm continually screaming to people, don't pay up, don't pay down, sit on the trade, wait for it. It's coming into a demand zone, wait there. Or it's going up, oh, should I buy now? No, wait for it. There will be a sell opportunity, because once you start to adopt that professional mindset that I only want to capitalize on trades when they're in supply areas, they're very high, or potential liquidity zones, that's where I want to get involved. And you get into the habit of that if the market is coming down into demand, I only want to get involved in major center open. So I don't want to be putting trades in 11. I don't want to be like, I just don't want that behavior. What I would rather do is see a major center open and then decide what I want to do, depending on where it's trading. So there are opportunities all the time in markets, but we want the highest probability trades. We don't want the wishy-washy stuff, the stuff that was just like, well, yeah, it could go right, it could go wrong, but it's not an advantageous position. And when we look at this board, look at how many advantageous places we're trading. We traded into a supply zone. This was late in the day, so it violates my time trifecta, so you won't normally see me taking a short here, but some people did take a short there, and they would have made money because it was an efficient place to sell. It was in a supply area. So if they were following the demand and supply model, the second trifecta alone, and weren't really considering anything else, that would have been a great trade to make. Because again, whilst there wasn't a lot of volume, i.e. level 1 volume liquidity there, it was definitely a supply area. So again, there was some conforming going on. So it could have been a good opportunity, but it violated the time trifecta, which is it wasn't a major center open. In fact, it was FTSE closed. So it's not really that interesting for me. I would have rather waited for demand, which is exactly where I would intend to belong, is from demand back into supply, right? And again, it is not rocket science, guys. It is just the reality of markets in a nutshell. We don't want to be trading long on premium prices and short on discounted prices, right? Which is what we're seeing here now. Again, it's just point in case, right? It's just you guys needing to understand that this is just how the game is. But if you look on the board, there were so many opportunities at these premium levels to be short. So for example, we had a liquidity high and a breakdown, but just look at it's 9 a.m. just an hour after the London Open. We're taking in some really crazy volume that is holding the market back, largest volume of the day. And then we come back into the New York Open, major center open. What do? We go back and we get filled up there. So patient traders had the opportunity to get filled back into the supply, right? You have to have confidence that this will happen. And if it doesn't happen, you miss out on the trade, no big deal, because guess what? We came straight into the demand area. We recovered upwards. And again, if you saw that we're in the demand area and we're reclaiming that, well then, yeah, you didn't get an opportunity to trade back into the demand. You could pass this trade up. Right? You can say, well, look, I'm not going to trade this because I didn't get a good fill into demand. So guess what? I'm going to look for the sell opportunity instead. And you would have gotten that here. And that was pretty much, well, if you're in Asia, you would have had it here. But even if you didn't get it there, no big deal. You would have had an opportunity to get long in the London demand. So at the end of the day, there's always a trading opportunity. Don't get obsessed with the fact that you didn't get to make the trade. It didn't meet your criteria. It's all about discipline, guys. The discipline to think about what this trade is going to be. The other thing I always say to guys is that, look, if you really want to take the trade, right? And let's say, you know, you saw this, it was a really good level. You really did believe we were going to go higher, and then we did, and we closed, and you wanted to be long, right? It's a major New York Open. Well, rather in this case, it was just an hour after the Chicago Open. But let's say you're confident we're going well. Well, then take a smaller position if you're going to violate the fact that you want to pay up. Well, pay up small, right? Because if this market did dip back, you can then average into the demand, get a better fill, and then go. So buy smaller, scale in, right? And if it did run away, then you'll have a smaller position, but then you would have had a chance to take part in that trade. So that's another way to kind of manage that, as opposed to thinking that I'm just going to come full line in, pay up on the offer, and it's all going to go my way. It might not. So guys, I hope this video really helped. I hope we understand what it means to pay up. And for those of you guys who saw my post on the Discord server today, you would have noted that, of course, I was advocating for the demand, and I said specifically, your only position should be long. You'll see that there. And what are you aiming for? Back into the supply. We have a weak high at the moment. We can already see that because the volume is very light. Most of it is the demand side. So my expectation is this may get broken into a major open. Again, we will be looking very keenly for where this thing will top, so we get an opportunity to be short as well. But for now, the market is still offering up. What we don't want to be doing is we don't want to be buying now. Again, this just goes back to this whole video, which is stop paying up on those trades. If you do that, you can keep losing money. It's not a goddamn thing you're going to be able to do about it because you keep paying up. Guys, to my next video. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?
Ha 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 ha!